In this second half of Maller's blueprint, we hit the real pressure point, the hodler's dilemma. Every Bitcoiner eventually faces the same question. Do you sell your best asset or do you starve? Maller argues there's a third path, one the wealthy have used for centuries. Borrow against your strongest collateral. Today we break down why Bitcoin changes the entire equation and why liquidity is the missing piece. Which leaves incidentally the next point, where Jack explained quite eloquently, is the dilemma of the hodler. So the famous hodler's dilemma. And what do we mean by hodl? It's the acronym HODL. It stands for holding on to your dear life. And the analogy there is if we're actually immersed in full outright war or entropy, what is the most precious thing that we have that we need to hold on to ourselves, right? So we don't lose it. Of course, it'll be your life, your family and next of kin. Obviously that has to be the top priority. But in terms of possessions on this earth, in the advent of entropy, to protect and behold, what will be your hold on to your dear life? You need to hodl on to that next available precious or prized possession that we have, which is time and energy conserved into Bitcoin. So Bitcoin is the hodl. It's the ultimate meme, which is strong but incomplete. Why are we saying it's incomplete? Hodl, we all been hearing an awful lot about the notion of, well, we need to hodl to our Bitcoins in the long term. And if we have spare cash around or unused assets, unused analog assets where they themselves are being debased, let's convert that into Bitcoin. The notion of DCA, you might have heard DCA, dollar cost average. It could be even euro cost average, pound cost average, or yen cost average, depending where you are in the world. It's still incomplete strategy. And it's true that we explain that why it is a hodl dilemma at the moment is because at some point you eventually would be needing a form of liquidity. So if you were in a position, which I think was Jack's position at the time, in my view, he has foolishly sold absolutely all of the cash, all of his wealth into Bitcoin. So he had 0% fiat, which clearly is no good because you need to have some form of fiat money to cover your expenses. I'm not trying to say to you that you ought to convert absolutely all of your wealth and fiat to Bitcoin. What I'm trying to say is you need to allocate and move away certainly off the 0% allocation to Bitcoin into a manageable percentage that you're comfortable with and hold it into the long term. The key point here is not enough just to hold on to your Bitcoin into the long term, i.e. to hodl or even to DCA. You need to eventually need some form of liquidity, and this is where he attempted to explain that is the predicament that every Bitcoiner that we are hitting ourselves against the wall, trying to ponder, do we sell or do we starve? And then he went on to say that history has shown that the wealthy don't sell their best assets, they actually borrow against them. So why should Bitcoiners be treated differently? So that is an important point, because the history that is shown in that clip, where the company, the British and the Dutch, they battled out and formed this company where they placed their hard assets as collateral in order to borrow against to get a loan, without the need to relinquish or sell off those hard assets. They used it as collateral in order to take out a loan. So that is an example of a best asset in order to achieve the loan itself. And that, by explaining that, has actually led him to the notion of, well, if we part some of our Bitcoins as collateral, we can do that. We can use that collateral, that hard asset collateral, in order to take out a fiat loan. And by doing that, by borrowing against Bitcoin, you're effectively tapping into wealth without actually selling or parting with your Bitcoin holdings, thereby preserving long-term upside. And this is where he explained, Strike's new Bitcoin collateral fiat loan product, which he went on to explain why there is no rehypothecation, which means that unlike the fractional reserve banking that we are used to, so when we go out and get a loan, or when institutions take out a loan with a bank, we are all competing with potentially the same finite set of collateral, because there is a multiple to one relationship in terms of collateral is held once in banks, but the banks have the propensity and the ability to have multiple loans on the same collateral asset to different type of lenders out there, and that's how they make the money, because every time they link a brand new loan request potentially to your own collateral savings that you hold in your bank account, well, usually there's a 1:20 loan ratio, so they loan 20 times for the same money they have in your bank account. That is rehypothecation. And what Jack is trying to explain as part of this Strike new Bitcoin collateral fiat loan product, well, there won't be any rehypothecation. It'll only be a one-to-one relationship. So the Bitcoin that you collateralize in the platform in order to issue out your fiat loan can only be done once. There's that one-to-one relationship, not in the fractional reserve banking where they have 1:20, 1:30 relationship. And then he goes on to explain some other attributes, which I'm not going to dwell on too much, but I just want to give you an idea as to what the Strike is doing as an example. Remember, there are different companies out there who are trying to tap into this market need at the moment. He goes on to explain that during the lifetime of the fiat loan, using your Bitcoin collateral, the collateral that you deposit in the platform will be held transparently, and only you can have access throughout the duration of that loan. And the interest rate that the Strike will actually charge you for that is in the single-digit interest rate. So this is just one example of collateralize your Bitcoin holdings in order to take out a fiat loan to cover those hip surgeries or day-to-day expenses that you may have, right, without actually having to part with your Bitcoin collateral. That is the example type of a Bitcoin collateralized loan or Bitcoin backed loan, if you like. And why he actually left that towards the end, because it is true that the actual predicament still remains, right? Because the only way at the moment, if type of product hasn't existed, we'll be still faced with the predicament of having to sell our Bitcoin holdings in order to capitalize on the gains and enjoy the proceeds as a result. But of course, that is a taxable event, which is not the case through this Bitcoin-backed loan, which has been explained by Strike and Jack Mallers on stage, which is another benefit. So not only will you not part with your Bitcoins throughout the duration of your fiat loan, you won't be taxed on it because you're not selling your Bitcoins. You're just using that as collateral in order to take out a fiat loan. So that is an advantage. So that's the core of Mallers' argument. Hodling alone is incomplete. DCA alone is incomplete because at some point every Bitcoiner needs liquidity. Borrowing against Bitcoin without selling it flips the entire game. No taxable event, no loss of upside, no surrender of your hardest asset. In the next part, we'll dig into the mechanics and risks behind Bitcoin-backed credit. Drop your thoughts below. This debate is just getting started. That's all I have for you for today. If you value clarity on Bitcoin, blockchain technology, and real assets tokenization, stay alert. Subscribe and enable all notifications to stay ahead of the curve. Share this episode with those who need to understand what's coming, friends, family, and colleagues. This channel aims to deliver insight, no noise, and no hype. Subscribe now.